Right now, as trading unfolds today on July 22, 2026, SoFi stock is trading at $17.31 per share, down about 1.90% on the session, after opening at $17.48 and bouncing between a morning low of $16.96 and a high of $17.61. That pullback might look like standard intraday noise to a casual observer scanning stock quotes, but beneath the surface, a bigger battle is taking place between institutional traders and retail investors. While mainstream commentary treats this daily price movement as a simple reaction to broader market sentiment, the underlying dynamic is driven by a clash over fair value loan accounting and capital retention strategy. Most retail traders looking at SoFi stock see a sleek, digital-first banking platform steadily taking market share from legacy institutions. The popular narrative assumes that as long as member growth keeps climbing and deposit balances expand, the stock price will naturally follow. However, the hard reality hidden inside the balance sheet reveals a far more nuanced picture. SoFi has transformed itself from a niche lending startup focused on refinancing student loans for high-earning college graduates into a full-scale digital financial institution. Yet its valuation still swings on credit risk, net interest margins, and loan sale velocity in the secondary market. When you compare how the market prices tech-focused lenders against traditional regional banks, you realize that expectations of effortless compounding are colliding directly with credit cycles, macroeconomic shifts, and capital adequacy rules. To understand why SoFi stock is moving the way it is today, we have to look closely at recent price swings, trading volume, and institutional activity. Over the past few weeks, daily trading volume in SoFi stock has consistently surged past 80 million shares per session, signaling heavy institutional positioning. Notice how the stock pulled back from recent highs near $19.74 down toward the 17 range over the last week. Part of that selling pressure was triggered by short seller scrutiny regarding fair value loan accounting, a topic that surfaced when Muddy Waters raised questions about how unhedged personal loans are marked on the balance sheet. SoFi management immediately pushed back, confirming that their accounting methods strictly adhere to U.S. GAAP guidelines and SEC requirements. Still, when short sellers target valuation formulas, institutional algorithms tend to reduce exposure first and analyze details later. That reaction created a sharp spike in volatility, driving heavy volume through options markets and creating rapid intraday reversals. Technical traders saw support levels tested around $17, while fundamental investors evaluated whether this dip represented a true disconnect between valuation and long-term operating profitability. When you compare SoFi stock to major tech names like Tesla stock, Apple stock, or Nvidia stock, the trading psychology is fundamentally different. Tech giants trade primarily on consumer demand, hardware product cycles, enterprise software spend, and artificial intelligence infrastructure investments. SoFi stock sits at a unique intersection of software multiples and commercial banking realities. Retail investors who manage their own portfolio through an individual brokerage account often treat SoFi as a high-growth technology company. They log into their trading platform, check member acquisition numbers, and assume the business can expand indefinitely without credit friction. But institutional money managers evaluate SoFi through a bank balance sheet perspective. They examine deposit beta, net interest spread, non-performing loan ratios, provisions for credit losses, and net charge-off rates. When benchmark treasury yields shift, or when credit spreads widen across consumer lending markets, institutional capital reprices SoFi stock instantly. That is why we see sudden sharp swings in the stock price even on days without official company news. Looking at how people execute self-investing strategies today, SoFi Invest competes directly in a crowded online ecosystem alongside platforms like Robinhood, SoFi Active Investing, and Interactive Brokers. Millions of retail investors rely on online investment tools to manage their financial health and evaluate online investing opportunities. For many, finding reliable investment help and choosing between top investing sites is the first step towards self-investing. Some users prefer to invest online using an intelligent portfolio approach, utilizing tools like Schwab Intelligent Portfolios to automate asset allocation. Others prefer direct trading through an individual brokerage setup. Within the mobile brokerage space, competition is fierce. Users regularly choose between the Robinhood app, which offers Robinhood stock trading, Robinhood investments, Robinhood crypto, Robinhood cash management, and Robinhood fractional shares, and SoFi Invest, which integrates SoFi stocks, SoFi ETFs, SoFi Robo-Advisor, SoFi Active Investing, and the SoFi trading platform. At the same time, legacy financial powerhouses like Fidelity remain massive players in wealth management. Through Fidelity Investments, clients access a massive ecosystem including Fidelity brokerage accounts, Fidelity ETFs, Fidelity mutual funds, Fidelity wealth management services, Fidelity IRAs, and the Fidelity mobile app or Fidelity trading platform. Meanwhile, active international traders and sophisticated individual investors often gravitate toward Interactive Brokers. They utilize Interactive Brokers trading, Interactive Brokers platform features, Interactive Brokers fee structures, Interactive Brokers account types, and specialized Interactive Brokers stock trading tools to execute complex strategies. SoFi's ability to gather low-cost deposits through high-yield checking and savings accounts has been its key strategic advantage against both traditional brokerages and fintech rivals, lowering its cost of funds compared to non-bank online lending competitors. Now is a great moment to pause and ask you directly. Comment below how many shares of SoFi stock you currently hold in your portfolio, or tell us if you think digital banks will completely replace traditional branch-based banking over the next decade. Sharing your perspective and trading experience gives everyone in our investor community valuable real-world insight into current retail market sentiment. To appreciate where SoFi is headed, it helps to review how the company actually operates and how its underlying business model has evolved over time. SoFi started as a niche lending startup focused on refinancing student loans for high-earning college graduates. Over time, executive management expanded product offerings into unsecured personal loans, home mortgages, credit cards, and digital wealth management tools. Obtaining a national bank charter was a decisive turning point for the organization, allowing SoFi to hold consumer deposits directly on its balance sheet, rather than relying exclusively on third-party bank warehouse funding lines. Beyond consumer banking, SoFi built a technology platform segment through its strategic acquisitions of Galileo and Technisys. This technology segment operates as a digital infrastructure backend for other financial technology firms and financial institutions, processing electronic transactions and powering core banking capabilities behind the scenes. In theory, this fee-based technology platform should diversify revenue streams and cushion SoFi against cyclical lending slowdowns. In reality, lending operations still generate the majority of net revenues and operating earnings, which explains why Wall Street continues to price SoFi stock as an emerging high-growth bank rather than a pure software enterprise. Looking ahead to the upcoming catalyst schedule, Wall Street is laser-focused on SoFi's financial reports and forward-looking management guidance. Analysts and institutional investors will be scrutinizing three core operational metrics: net interest margin stability, loan originations volume, and fee revenue acceleration from non-lending business lines. If loan originations continue to grow while credit performance remains well within management's forecasted loss parameters, the bear thesis surrounding loan valuation will lose traction rapidly. On the flip side, if macroeconomic headwinds weigh on consumer credit health, or if secondary market demand for personal loan packages weakens, SoFi may have to retain a larger portion of loans on its balance sheet for extended periods, consuming regulatory capital and slowing down capital return plans. The expectation among optimistic retail investors is that fee-based financial services and technology platform growth will smoothly elevate return on equity toward classic tech software multiples. The underlying reality is that credit execution and interest rate stability in consumer personal loans will dictate stock price direction over the coming quarters. In closing our analysis today, the expectation versus reality framing around SoFi stock highlights why this ticker remains one of the most closely watched and debated equities in the entire financial sector. The popular market expectation paints SoFi as an unstoppable digital finance leader poised to disrupt traditional banking with continuous user expansion. The deeper reality shows a high-quality, rapidly growing business navigating complex macroeconomic conditions, regulatory capital requirements, and credit market fluctuations. While short-term price swings and short seller debates will test investor patience, SoFi's low-cost deposit foundation and multi-product financial ecosystem provide significant long-term structural advantages. Succeeding as an